Hello, I'm Maria Dawes, one of the portfolio managers at Capstone Asset Management. Welcome to another edition of Your Wealth Matters, where today we'll be talking about alternative investments. And joining me today is my fellow portfolio manager, Janet Kimsing. Hi, Janet.
Hi, Maria. I'm excited about this topic.
And rightly so. So, alternative investments or non traditional investments are, in a way, the bread and butter of what we do at Capstone. We see stock markets that keep reaching new record highs amidst uncertainty in terms of our economic recovery. And we also have continued low interest rates and low bond yields. And this leaves investors who don't necessarily want the risk of an inflated market, nor having their principal eroded through inflation, with few alternative options in traditional marketplaces. And fortunately, there are options. Non traditional investments have long existed, but too few investors know about them, or perhaps more accurately, know how to access them.
Yes, and hopefully in this session, we can clearly articulate the power of including these types of investments in a portfolio. You may not have realized it before, but non-traditional investments are all around us, but too few investors know about them, or perhaps more accurately, know how to access them. But I'm getting a bit ahead of myself. First, we should probably define what alternative or non-traditional investments actually are.
Probably a logical starting point. So, Janet, why don't you start us off on that front?
Sure. So non-traditional investments are fairly broad in nature and typically include investments outside the scope of the traditional bond and stock markets. They generally do not trade on public exchanges. Some common examples include private debt, real assets, commodities, private equity, and infrastructure projects, to name a few. Non-traditional investments are often characterized by high yields, high returns, or both, and they generally do not react in the same way as traditional investments in terms of the ups and downs of the bond and stock markets.
So far, this all sounds good, but it also begs the question of why then don't more people have alternatives in their portfolios?
Well, I would say there has been more talk of inclusion now, certainly more than even 5 years ago. And this is probably a response to the increasing amount of traditional market volatility we have seen as of late. However, for long periods of time already, large pension funds, endowments, as well as institutions have recognized the need to include non-traditional assets in their investment strategies to provide better downside protection and improve their diversification. But unfortunately, many investors have not been afforded the same opportunity because they don't know where to get these types of investments, or they're not in a position to put up massive amounts of capital straight away. Also, there may be very limited liquidity involved, which means that it can take a long time to get their investment back, sometimes even more than 5 years. In addition to overcoming these hurdles, the world of non-traditional instruments is very diverse and can be difficult to navigate as a retail investor. So yes, I know that all sounds like too many hurdles and challenges for the average investor, but
But the good news is that at Capstone, we have been able to circumvent these hurdles. As an investment funds manager and portfolio manager, we have designed investment pools to enable our clients to take advantage of the many opportunities in this complex arena. Capstone's investment management team employs a rigorous due diligence and analysis process on each investment opportunity, and this is then topped off by a separate review by our compliance team. So while it is true that we could still be dealing with numerous investment hurdles, like, for example, lockup periods, because of the pooled fund structure, we can mitigate these by ensuring other investments offset these hurdles. For example, if one investment has a lockup period, we can combine investments with different liquidity parameters to ensure liquidity is available to the fund's investors.
so Maria, let's get down to brass tacks. How big of an impact does incorporating alternatives or non-traditional investments have on a client's overall returns?
I am glad you asked, Janet, because the impact is actually really significant. I think the easiest way to show this is to look at a pretty basic example. At Capstone, one of our most popular funds is the Capstone Mortgage Pool. And this is exactly what it sounds like. It's a private mortgage fund that we launched in 2012. As you can see in the chart shown, its performance is very stable. So overall, the risk with this investment isn't really its volatility, but rather you could say it's the liquidity of the fund, since investors have to wait up to a few months to withdraw their money should they need to. So the liquidity risk is there, but not so much the volatility risk. And if you look at its performance compared to the TSX, for example, you can see how significantly different they are. Their returns are totally unrelated or uncorrelated. So you can imagine if you could add this type of investment into a diversified portfolio, how much more stability you could add to your portfolio overall. In essence, you've just introduced a security that is not correlated to your other holdings, and you reduced your standard deviation or your overall portfolio volatility. Now imagine if you had more options than just this type of mortgage pool. If you added other uncorrelated investments like private equity or infrastructure or real estate holdings, there are lots of options to consider. If these get added into the mix, how much better would your diversification be and how much better could you mitigate your overall portfolio risk?
Thanks, Maria. Those charts are very telling, and hopefully this has given an idea as to what alternatives are, their positive impact on really any sort of existing portfolio, and how Capstone incorporates alternatives into its own funds. The uncorrelated nature of non-traditional investments in relation to a perhaps more traditional stock and bond portfolio is a compelling reason to include them in a diversified portfolio. Especially during these times of uncertainty, attention and dedication must be put towards seeking investments that perform as well as offsetting different risks, regardless of the traditional marketplace. If you would like to talk to us more about what we've discussed here, please do not hesitate to be in touch with your portfolio manager directly. Bye for now, and until next time.
Bye.